Friends, thank you for being here today. What if I told you that the people who print the money are firing themselves to save money? Let me be precise about what that sentence means. In January 2026, the Bank of Canada, the institution that controls the currency, sets interest rates, and manages the nation's monetary policy, announced it would eliminate 225 jobs. That's roughly 10% of its entire workforce, gone by mid 2026. This is not a struggling retailer closing stores. This is not a tech startup running out of venture capital. This is the central bank, the money printer, and they are firing their own economists to meet austerity targets. If the institution responsible for economic stability cannot afford its own staff, what does that tell you about the stability they're supposed to be managing? This is vanishing in real time. Here's the part nobody expects. This isn't happening in isolation. On January 6, 2026, Scotiabank, one of Canada's big five banks, confirmed it had eliminated 3,000 positions. Not tellers, not entry level staff, middle management, head office roles, the people earning $100,000 to $150,000 per year. The bank took a $373 million restructuring charge just to pay the severance packages. And on January 5th, General Motors began permanent layoffs affecting over 1,100 workers at its Canadian facilities. Factory Zero, Cami plant uncertainty. The EV transition that was supposed to create millions of jobs is instead erasing the ones that already exist. We are not witnessing a labor shortage. We are witnessing a white collar purge, and this part has already begun. Let me show you what actually happened. The Bank of Canada operates under a federal mandate. In late 2025, the Canadian government quietly enforced a directive: trim operating costs by 15% by 2028. This wasn't a suggestion. This was an order. The central bank, despite having the theoretical ability to fund itself indefinitely, was told to shrink. Here's the detail even analysts tend to miss. The Bank of Canada doesn't just employ clerks and security guards, it employs PhD economists, policy researchers, financial analysts. These are people who study inflation, unemployment, GDP growth. They write the reports that shape monetary policy, and now 10% of them are being shown the door. What I call the big secret of the entire system is this: when the institution responsible for measuring economic health starts cutting its own measurement capacity, they're not trying to save money. They're trying to reduce the number of people who can see what's coming. This is the mechanism hiding in plain sight. But that's not the real problem. The Scotiabank cuts tell a darker story. When the CEO announced the restructuring in early January, he used the word efficiency 17 times in a single earnings call. Efficiency. That's corporate language for we don't need you anymore. Here's what that looks like on the ground. Scotiabank didn't eliminate 3,000 jobs because it was losing money. The bank is profitable. It eliminated those jobs because it projected zero revenue growth in 2026 and 2027. In a zero growth environment, every employee becomes a liability on the balance sheet. This is where common sense actually becomes your enemy. You've been told that banks need people to serve customers. That's no longer true. AI chatbots handle inquiries, automated systems process loans, mobile apps replace branches. The middle manager who used to oversee a team of 12, that position is now a Python script. Let's cut through the noise. The $373 million severance charge wasn't an act of generosity. It was the cost of escape. Scotiabank paid that money to avoid paying salaries, benefits, pensions, and office space costs for the next decade. In their calculation, it was cheaper to fire 3,000 people today than to keep them employed tomorrow. And here's where everything changes. General Motors tells the same story from a different angle. The automotive giant promised Canada a future of electric vehicle manufacturing, billions in government subsidies, thousands of green jobs, a manufacturing renaissance. Instead, Factory Zero, the flagship EV plant, is laying off workers in waves. The Ingersoll Cami plant sits in limbo. The EV transition isn't creating jobs, it's a cover story for automation and offshoring. This part isn't a prediction, it's math. An internal combustion engine requires roughly 2,000 parts. An electric motor requires about 20. Fewer parts mean fewer suppliers. Fewer suppliers mean fewer workers. The green transition is actually a workforce reduction strategy dressed up in environmental language. We don't have months. This is happening in days. Here's the part they never put in the official reports. These three events, Bank of Canada, Scotiabank, General Motors, all happened within 72 hours of each other in early January 2026. That's not coincidence, that's coordination. When major institutions synchronize layoffs, it means they've all received the same memo. The memo says 2026 is the year we cut costs, not grow revenue. Protect the balance sheet, sacrifice the workforce. This is where the first domino falls. The official unemployment rate in Canada sits around 6.5% to 7.0%. That number is a lie by omission. It counts people who are actively looking for work. It doesn't count the underemployed. It doesn't count the former bank executive who now drives for Uber. It doesn't count the laid-off policy analyst who took a $60,000 job after losing a $150,000 position. What the statistics call employment is actually survival. Let me be precise. White-collar unemployment is invisible. When a factory closes, it makes the news. When a bank eliminates an entire division of salaried professionals, it's announced in a footnote on an earnings call. The pain is distributed quietly across thousands of households. This is the detail economists tend to miss. Severance packages have a shelf life. Most corporate severance agreements provide 6 to 12 months of income. For workers laid off in mid-2025, those packages ran out in late 2025 or early 2026. Right now, and this is where the cascade becomes unstoppable. The people who lost their jobs in 2025 spent the second half of the year living on severance, updating resumes, and applying to positions that don't exist. By January 2026, the savings buffer is gone. Mortgages come due, car payments hit, credit cards max out, but once this shifts, everything above it starts to shake. Here's what nobody expects. The largest employer in Canada isn't a corporation. It's the government, federal, provincial, municipal combined. And the government has quietly implemented a hiring freeze across most departments. The Bank of Canada cuts are just the visible edge of a much larger austerity program. When the central bank fires 10% of its staff, it sends a signal to every federal agency. You're next. The safety valve is closed. For decades, white-collar workers who lost private sector jobs could find refuge in government employment, stable hours, decent benefits, pension security. That option is evaporating. The government is shrinking, not expanding. This is not theoretical, it's observable. Here's the part that scares me most. We are not in a recession yet. GDP growth is low but positive. Inflation is moderating. Interest rates are starting to decline. By every traditional metric, the economy is soft landing, and yet the institutions are behaving as if a Category 5 hurricane is offshore. The data forces one conclusion. Banks don't fire 3% of their workforce during a soft landing. Central banks don't eliminate policy researchers when everything is stable. Automakers don't shutter plants when demand is strong. These institutions have access to data we don't see: credit card delinquency rates, mortgage default projections, business loan applications, and whatever they're seeing in that data is terrifying enough to trigger mass layoffs before the official recession even begins. This was inevitable the moment the federal government ordered the Bank of Canada to cut costs. But this isn't even the part that scares me. The structural issue is deeper than jobs. It's about the economic model that created those jobs in the first place. For 30 years, the Canadian economy ran on cheap credit, rising home prices, and resource exports. That model is breaking. Cheap credit is gone. Interest rates are still elevated compared to the 2010s. The era of free money ended in 2022 and it's not coming back. Rising home prices are stalling. The housing market is frozen. Buyers can't afford the payments. Sellers won't drop prices. Transactions have collapsed. The wealth effect that drove consumer spending is reversing. Resource exports are under pressure. Oil prices are volatile. Lumber demand from the U.S. is softening. Mining projects face environmental and regulatory delays. Here is where the breaking point approaches. When your economy is built on three pillars and all three are cracking simultaneously, there's no soft landing. There's only the question of which pillar breaks first. Let me show you what actually happened in the final weeks of 2025. The Bank of Canada held an internal strategy meeting in December. According to leaked internal documents reported by financial press, the institution's leadership acknowledged that maintaining current staffing levels was fiscally unsustainable under the new federal budget constraints. Here's the insider detail. The bank didn't want to cut staff, it was forced to. The federal government is running a deficit and facing pressure to reduce spending across all agencies. The Bank of Canada, despite its independence in monetary policy, still operates under federal budget oversight for its operational expenses. This is a default in all but name. The government can't afford to fund the institution that manages the currency. Let that sink in. Canada cannot afford to pay the people who run its monetary system. And here's where the countdown quietly began. The Scotiabank restructuring reveals the next layer of the crisis. When Scott Thompson announced the 3,000 job cuts in early January, he framed it as proactive management, getting ahead of the curve, positioning the bank for long-term success. The financial media praised the decision as bold leadership. Here's what that actually means. Scotiabank's internal projections show zero revenue growth for 2026 and 2027. Not slow growth, zero. The bank looked at its loan portfolio, its mortgage book, its investment banking division, and concluded that revenue would be flat for at least 2 years. In banking, flat revenue is a death sentence. Banks operate on leverage. They borrow money at low rates and lend it at higher rates. The spread is profit, but when interest rates are elevated and loan demand collapses, the spread compresses. New mortgages aren't being written, business loans aren't being extended, credit card balances are being paid down, not expanded. This part is non-negotiable. Without revenue growth, every dollar spent on salaries comes directly out of profit. The bank had a choice: cut dividends to shareholders or cut employees. They chose employees. They will always choose employees. The $373 million severance charge breaks down to approximately $124,000 per employee. That sounds generous until you do the math. Most of those 3,000 workers were earning $80,000 to $150,000 annually. The bank paid roughly 1 year of salary to eliminate decades of future costs. For the bank, it's the trade of the century. For the employees, it's financial devastation. And this is the crack that becomes an earthquake. Because Scotiabank isn't alone. RBC, TD, BMO, CIBC. All of Canada's major banks are facing the same revenue stagnation. If Scotiabank cut 3,000 jobs, the other banks are running the same calculations right now. This is vanishing in real time. Multiply 3,000 by 5 banks. That's 15,000 banking jobs potentially on the chopping block in 2026. Add insurance companies, add wealth management firms, add fintech startups that are running out of venture funding. The white collar purge isn't a Scotiabank problem. It's a sector wide extinction event. But once this shifts, everything above it starts to shake. Let's talk about what happens to those 3,000 Scotiabank employees. Most of them live in Toronto, Montreal, or Vancouver, Canada's most expensive cities. They have mortgages, car payments, kids in private schools or university. They built their lives around six-figure incomes. Here's what that looks like on the ground. The severance package lasts 6 to 12 months. During that time, they apply for jobs, but there are no jobs. Every other bank is cutting or freezing hiring. Tech companies are in their own downturn. Government positions are locked behind hiring freezes. By month 8 of unemployment, the panic sets in. Savings are depleting. The mortgage payment is due. The car lease can't be renegotiated. They start applying for positions below their experience level. $120,000 jobs become $80,000 jobs, become $60,000 jobs. This is where the money illusion collapses. They were never rich. They were high income. There's a difference. Rich people own assets that generate cash flow. High income people trade time for money. When the time is no longer wanted, the money stops. The former Scotiabank analyst who now works at a call center for $22 per hour is still employed. They're still paying taxes. They still show up in the statistics as employed, but they've lost 75% of their income and 100% of their career trajectory. This doesn't show up in GDP, it shows up in divorce rates, antidepressant prescriptions, and U-Haul rentals to cheaper cities. We haven't even reached the breaking point yet. Now let's examine the General Motors situation through the same lens. GM's Factory Zero was supposed to be the future. Electric Silverado trucks, Hummer EVs, the rebirth of American manufacturing on Canadian soil, billions in government subsidies, Trudeau standing at a podium promising a green industrial revolution. 2 years later, the factory is laying off workers in waves. Here's the part the experts gloss over. Electric vehicles have a demand problem, not a supply problem. Consumers don't want them at current prices. The total cost of ownership is higher than advertised. Charging infrastructure is inadequate. Cold weather performance is poor. Resale values are collapsing. Automakers built production capacity for a demand curve that doesn't exist. Let me be precise. GM projected selling 400,000 electric vehicles in North America in 2026. Current run rate suggests they'll sell about 180,000. That's a 55% miss. You can't run a factory at 45% capacity. The math doesn't work. So they cut workers, then they cut shifts, then they idle entire production lines. This is not a conspiracy. It is a stated policy. GM's CEO has publicly stated that the company will not sacrifice profitability to meet arbitrary EV targets. Translation: if EVs don't make money, we'll stop making them. And if we stop making them, we don't need the workers. The 100 layoffs at Factory Zero and related facilities are just the beginning. Supplier companies are next. The Canadian auto parts manufacturer that retooled for EV components, they're bleeding cash. The logistics company that built a business around EV delivery, they're downsizing. And here is where the cascade becomes unstoppable. This is the domino sequence. GM cuts workers. Workers stop spending. Local businesses lose customers. Local businesses cut staff. Tax revenue declines. Municipal services get cut. The spiral feeds itself. The Ingersoll Cami plant is the perfect example. The plant was supposed to transition from building the Chevy Equinox to building electric delivery vans. The vans were supposed to be ordered by companies like FedEx and UPS. The orders never materialized. Now the plant sits in limbo, not officially closed, not actively hiring, just waiting. The workers have been temporarily laid off for months, but temporary is becoming permanent. The severance calculations are being prepared right now. This is where the first domino falls. Here's what I call the convergence: three separate forces hitting simultaneously. Force one: corporate efficiency drives, AI automation, cost cutting, margin protection. Companies would rather fire 10 people and buy one software license. Force two: government austerity, hiring freezes, budget cuts. The Bank of Canada eliminating 10% of staff is the model every federal agency will follow. The safety net is being shredded. Force three: manufacturing stagnation. The EV transition is failing. Infrastructure projects are delayed. Resource sector is volatile. The real economy jobs aren't coming back. This part isn't a prediction, it's math. When all three forces converge, you get a labor market that looks healthy on paper but is rotting underneath. Unemployment stays low because people take any job they can find, but underemployment skyrockets. Income drops, living standards collapse. The official statistics become propaganda. But this isn't even the part that scares me. The psychological dimension is worse than the economic one. Human beings are hardwired to believe tomorrow will look like yesterday. It's called normalcy bias. It's the reason people don't evacuate before hurricanes. It's the reason investors don't sell before crashes. And it's the reason white-collar workers don't see this coming. Here's the insider detail. If you're reading this and you have a comfortable office job, you likely believe you're safe. You perform well. You get good reviews. Your boss values you. The company just posted profits. None of that matters. Let me show you what actually happened at Scotiabank. The 3,000 people who were fired weren't underperformers. They weren't disciplinary problems. They were simply categorized as non-revenue generating. That's the only criteria that mattered. Do you directly bring money into the company? If yes, you're safe. If no, you're vulnerable. Here's what that means in practice: salespeople are safe. Engineers who build products are safe. Customer service reps who prevent churn are safe. Middle managers who oversee processes, vulnerable. HR staff who manage culture, vulnerable. Policy analysts who write reports, vulnerable. Communications specialists who craft internal memos, vulnerable. This is where common sense actually becomes your enemy. You think your institutional knowledge protects you. You think your 15 years of experience matters. You think your relationships with executives provide security. The spreadsheet doesn't care. When the CFO runs the model, your name is just a number. Salary, $130,000. Benefits, $30,000. Office space allocation, $12,000. Total cost, $172,000 per year, multiplied by 20 years until retirement, $344 million. For $344 million, they can hire 3 junior people, get 90% of the output, and pocket the difference. This was inevitable the moment revenues stopped growing. Let me cut through the noise and give you the timeline. January 2026. The layoffs are announced. Bank of Canada, Scotiabank, GM. The white-collar purge begins February to April 2026. Severance packages sustain the laid-off workers. Job applications flood the market. Hiring freezes spread. Desperation builds. May to August 2026. Severance runs out. Mortgage defaults begin. Consumer spending craters. Retail earnings collapse. The second wave of layoffs hits September to December 2026. The official recession is declared, but it's not news, it's confirmation. The professionals who thought they were safe realize they're not. We don't have months, this is happening in days. Here's the moment the clock actually starts, right now, January 2026. The institutions have shown their cards. They've told you they're cutting before the storm hits. They're not waiting for the recession to arrive. They're preparing for it now. And here's where everything changes. If the Bank of Canada is firing economists, Scotiabank is firing bankers, and GM is firing auto workers, what makes you think your employer won't fire you? Loyalty is a liability. The Bank of Canada employed those 225 people for years, some of them for decades. They had pensions, they had seniority, they had security, and they were eliminated with a memo and a severance check. Scotiabank called its employees family in every corporate communication until the day it fired 3,000 of them to protect profit margins. Your employer will do the same. This is not theoretical, it's observable. The convergence is complete. Now, let me show you what comes next. We are entering what I call the white collar recession. This is not your grandfather's economic downturn. In previous recessions, blue collar workers bore the brunt. Factories closed, construction stopped, retail contracted. This time, it's different. The jobs being eliminated require degrees, they require certifications, they require years of training and expertise. These are the jobs that were supposed to be recession proof. The jobs parents told their children to pursue: go to university, get a good job, work for a bank or the government, be secure. That contract is void. Here's the part nobody expects: the middle management layer is being permanently removed from the economy. It's not coming back. Companies have discovered they can operate with fewer supervisors, fewer administrators, fewer coordinators. Technology filled the gap. Project management software replaces project managers. AI assistants replace executive assistants. Automated reporting systems replace analysts. The layer of humans who moved information from one place to another is obsolete. This is where the countdown quietly began. But once this shifts, everything above it starts to shake. Let's talk about the second order effects. When 225 Bank of Canada employees lose their jobs, they stop spending. They cancel the gym membership. They stop dining out. They delay the car purchase. They pull kids from extracurricular activities. Multiply that by 3,000 Scotiabank employees. Multiply that by 2,100 GM workers. Multiply that by the tens of thousands of other layoffs happening quietly across the Canadian economy. For the average household, this means the customers disappear. The restaurant that relied on lunch crowds from the nearby office tower. Revenue drops 40%. They cut staff. The remaining servers' hours get reduced. Those servers stop shopping at the local boutique. The boutique cuts staff. The spiral accelerates. This is the detail even analysts tend to miss. GDP measures total economic output. It doesn't measure how that output is distributed. When a bank fires 3,000 people earning $100,000 each, that's 300 million in lost wages annually. But the bank's profit margin improves. GDP might even go up because productivity per worker increases. The statistics say the economy is fine. The people living in it know better. And here is where the cascade becomes unstoppable. The housing market is the next domino. Canada's economy runs on residential real estate. When high income professionals lose their jobs, they can't make mortgage payments. Not immediately. Severance buys time. But eventually, here's what that looks like on the ground. A family earning $180,000 per year could afford a $900,000 mortgage. Both spouses had stable jobs. Then one gets laid off. Income drops to $100,000. The mortgage payment doesn't change. It's still $4,500 per month. For 6 months, they use savings. For another 6 months, they use credit cards. By month 12, they're negotiating with the bank. By month 14, they're listing the house. But there are no buyers because the pool of qualified buyers is shrinking at the same rate as the layoffs. The people who could afford $900,000 homes are the same people getting fired. The market freezes. This is not a conspiracy. It is a stated policy. The Bank of Canada's own data shows mortgage stress tests are failing at higher rates. Applications are being denied. First-time buyers have disappeared. The only transactions happening are distressed sales and investor purchases at deep discounts. Here's the part they never put in the official reports. Canadian household debt to income ratio is at 180%. That means the average household owes 180 for every dollar of annual income. This is sustainable only when income is stable and rising. When income disappears, that ratio becomes a noose. Let me be precise. The average severance package is 1 to 2 weeks of pay per year of service. A Scotiabank employee with 10 years of experience gets roughly 6 months of severance. That sounds generous until you realize it takes an average of 9 to 14 months to find comparable employment in this market. The gap between severance and re-employment is the danger zone. This is where small businesses get crushed. The laid off professional burns through severance, then maxes out credit cards, then stops paying everything except absolute necessities. Mortgage, utilities, groceries, everything else stops. The gym membership cancels, the streaming services cancel, the monthly donations stop, the discretionary spending evaporates. For pensions, this is catastrophic. Here's what I call the big secret of the entire system. Public sector pension funds in Canada are massively underfunded. They've been relying on two things: continuous contributions from employed workers and investment returns from the stock market. Both are failing simultaneously. When the government implements hiring freezes and cuts staff, pension contributions decline. When the stock market corrects due to recession fears, investment returns collapse. The pension funds have to liquidate assets to pay current retirees. This is a default in all but name. The data forces one conclusion. If you are under 45 years old and expecting a government pension, you need to operate as if it won't exist. The math doesn't work. The system is a Ponzi scheme running out of new contributors. But this isn't even the part that scares me. The psychological breaking point is approaching. For 30 years, Canadians were told that education and white-collar employment provided security. Get a degree, work in an office, climb the corporate ladder, retire with dignity. That entire worldview is shattering in real time. The 28-year-old with $60,000 in student loans who just got fired from their first career job at Scotiabank is having an existential crisis. They did everything right. They studied, they networked, they performed, and they're unemployed anyway. Here's where common sense actually becomes your enemy. They'll blame themselves. They'll think they should have worked harder, been more indispensable, built better relationships. They'll internalize the failure. The truth is, the system failed them. The social contract was broken before they even entered the workforce. The promise of stability in exchange for obedience was always a lie. They're just discovering it now. This is where the first domino falls in the social order. When an entire generation realizes that playing by the rules leads to poverty anyway, they stop playing. They stop contributing to RRSPs. They stop saving for down payments. They stop planning for a future that won't arrive. They exist in survival mode, paycheck to paycheck, gig to gig, crisis to crisis. This was inevitable the moment the Bank of Canada started firing economists. Let me show you what actually happened in the final calculation. The institutions looked at 2026 and made a choice. They could distribute pain slowly over many years, small wage freezes, hiring slowdowns, gradual attrition, or they could amputate quickly, mass layoffs, immediate cost savings, protected profit margins. They chose amputation because slow decline is harder to manage than fast collapse. Slow decline requires explaining to shareholders every quarter why margins are shrinking. Fast collapse lets them blame market conditions and unprecedented challenges. One press release, one restructuring charge, problem solved for them, not for you. And here's where everything changes permanently. The recovery won't restore these jobs. This is the critical point everyone is missing. When the recession ends, and eventually it will, companies won't rehire the middle management layer. They'll have operated for 18 to 24 months without those positions and discovered they didn't need them. The corporate restructuring of 2026 is permanent. AI and automation will continue advancing. The efficiency gains from leaner operations will be locked in. The new normal will have fewer employees, lower wages, and higher productivity metrics. If you're waiting for things to go back to the way they were, you're going to be waiting forever. Here's the moment the clock actually starts for your personal situation. Today, right now, this moment. If you are employed in a white collar position that doesn't directly generate revenue, you need to operate as if you're going to be fired in the next 6 months. That's not pessimism, that's realism. Update your resume today, not tomorrow. Today, build your network. Identify skills that are transferable. Consider side income streams. Reduce fixed expenses. Build an emergency fund that can last 12 months, not 3. The window for preparation is closing. Let me cut through the noise and tell you what this really means. The binary choice is simple: adapt or suffer. You can either acknowledge that the employment landscape has permanently shifted and adjust your strategy accordingly, or you can maintain normalcy bias and hope your employer values loyalty over profit margins. One of those approaches ends in security, the other ends in surprise. History favors the prepared. The Bank of Canada fired 10% of its staff to prepare for what's coming. Scotiabank fired 3,000 people to prepare for zero growth. General Motors is idling factories to prepare for lower demand. The institutions are preparing. The question is, are you? This is not theoretical, it's observable. The layoffs have already happened. The restructuring charges have been paid. The severance packages are running out right now in real time while we speak. The white collar recession isn't approaching, it has arrived. The only question is whether you'll be ready when it reaches your desk. Friends, thank you for being here today. I know this information is difficult to hear. It contradicts everything we were taught about career stability and economic security, but the evidence is undeniable. When the central bank fires its own economists, when major banks eliminate thousands of positions, when manufacturing plants idle their workers, these are not isolated incidents. These are signals. The system is contracting. The professional class is being compressed. The middle is being eliminated. Your move